You know, the stark reality of financial analysis is that the numbers on a balance sheet are really only as reliable as the independence of the parties creating them.
Right.
I mean, billions of dollars in debt can be completely hidden from view. Millions in totally fraudulent revenue can just be magically created out of thin air.
Yeah, just fabricated.
Exactly.
Yeah.
And how is it done? Simply by transacting with a related entity. So welcome to Talk Tickers.
Glad to be here.
On this deep dive, you are covering a CFA-aligned financial analysis concept. We're going to be exploring the impact of related party transactions, or RPTs, on financial statement reliability, earnings quality, and, well, corporate governance as a whole.
It's a huge topic.
It really is. You know, usually when you talk about financial analysis, there's this expectation of precision, right? Like engineering.
Sure.
You look at a balance sheet, you see the numbers, the cash, the debt, and you think, okay, there it is. That is the physical reality of the business.
Yeah, it feels completely binary. Like if you're a junior analyst building your first model, you just assume the revenue was either generated or it wasn't.
Right.
The debt is either sitting there on the books or it doesn't exist. You take the 10K, you plug the top line revenue into your Excel sheet, and you just start forecasting.
It's clean and it's comforting, honestly. We like our financial models to be built on solid, unquestionable foundations.
Oh, absolutely.
We want to believe that when a company reports, say, $100 million in sales, that represents $100 million of genuine organic market demand from real customers.
Customers who desperately wanted that product, yeah. But then, you know, you step into the world of complex corporate structures.
Oh, boy.
Right. Multinational conglomerates, interconnected entities, and suddenly that comforting precision completely evaporates.
Just poof, gone.
Exactly. We are looking at a financial landscape that is incredibly murky. Because if the parties doing business together aren't actually independent, then the margins, the growth rates, and the risk profiles that you're so carefully modeling well, they might be completely engineered.
Engineer is the perfect word for it. So we need to unpack the mechanics of this, because this is the core of what you must understand as a financial analyst or a CFA candidate.
You really do.
You have to know how to look past the top line revenue to understand exactly who is buying and who is selling. Like if a company is reporting massive growth, but 80% of their sales are going to a subsidiary owned by the CEO's brother-in-law.
Which happens more than you'd think.
Right. That is a completely different risk profile than selling to Walmart or Target.
What's fascinating here is that we aren't necessarily talking about blatant mask and gun robbery or obvious embezzlement.
Oh, it's much quieter than that.
It is. We are talking about agreements, supply contracts, loans that look entirely legitimate on the surface. I mean, they have legal documentation.
They've got the invoices, the letterhead, everything.
Exactly. But because of the pre-existing relationships between the entities involved, the true economic substance of those transactions might be completely divorced from what is actually recorded to the public markets.
So let's start with a basic definition just to ground us, and then I want to get into the specific math of how this actually distorts a valuation model.
Sounds good.
What exactly is a related party transaction? At its simplest, it's any business dealing. So an agreement, a sale, a loan, a service provision, a property lease between a company and an entity with which it has a pre-existing relationship.
And that umbrella is very wide.
Very wide. It includes parent companies, subsidiaries, affiliates, principal owners, executives, board members, or even just the close family members of the management team.
Right. And while these transactions are incredibly common in the corporate world, they require specialized, careful attention in financial reporting.
Because of the conflict risk.
Exactly. Regulatory standards, whether you're looking at international financial reporting standards, so IFRS or US GAAP, they strictly mandate that companies disclose these relationships in the footnotes.
You can't just hide them in the aggregate data.
No, they have to report the nature of the relationships, the types of transactions involved, the actual dollar amounts, and any outstanding balances at the end of the year.
Which brings us to the gold standard, the absolute baseline for evaluating any of this, which is the arm's length principle.
The holy grail of transfer pricing.
Right. So I want to spend some time here because this dictates everything we're going to talk about today. Explain how the arm's length principle works in theory.
Sure. So the arm's length principle dictates that a transaction between related parties should be priced, structured, and executed exactly as it would be if the two parties were complete strangers.
Strangers who don't care about each other at all.
Exactly. Acting independently and acting entirely in their own best economic interest. It's the international standard.
Right.
It's codified in places like Article 9 of the OECD Model Tax Convention, and it forms the basis of transfer pricing rules in, I think, over 140 countries worldwide.
Wow, so it's universal.
Pretty much. If you want to know if an RPT is legitimate, you just ask, would two strangers have agreed to these exact same terms?
I think an analogy really helps here to make this concrete for you listening.
Yeah.
Say you're analyzing a mid-sized, founder-led logistics company.
Okay.
You're looking at their income statement and you notice their operating expenses are incredibly low. You dig into the footnotes and realize the company rents its primary distribution warehouse directly from the CEO, who happens to own the building personally.
A classic setup.
Right. So arm's length means the company should be paying the exact same $50 per square foot market rate that they would pay to just a random commercial landlord across town.
Yeah.
But it's not just about the top line price.
Right.
It means the exact same lease terms, the same duration, the same penalty clauses for breaking the lease.
Precisely. It has to be a mirror image of a real market deal. Let's look at how that distorts evaluation if it's not arm's length.
Okay, let's run the numbers.
Imagine the real market rate for that warehouse is $1 million a year. But the CEO, wanting to make the public company's earnings look fantastic to drive up the stock price, leases it to the company for only $200,000 a year.
Oh, wow. So operating expenses are artificially suppressed by $800,000.
Exactly.
Which means EBIT to earnings before interest, taxes, depreciation, and amortization is artificially inflated by that exact same $800,000.
Yes, it flows straight down. And if you as an analyst are applying a standard, say 10x EBITDA multiple to value that business,
Which is pretty standard.
right, that sweetheart lease agreement just created $8 million, a completely fake enterprise value.
$8 million out of thin air.
Out of thin air, the company looks far more profitable than it actually is, simply because the CEO is personally subsidizing the rent.
And if the CEO leaves or sells the building to someone else, the new landlord will instantly hike the rent back to market rates.
Instantly. And that $8 million in enterprise value just vanishes overnight.
That is exactly why this concept is featured so heavily in the CFA curriculum. It's crucial for you to understand that related party transactions are not inherently illegal.
Right. They aren't forbidden by law.
The CEO renting the building to the company is perfectly legal, but they carry a massive, glaring risk of conflicts of interest. Without evaluating the disclosures around these transactions, you simply cannot accurately assess a company's true financial position.
You're flying blind.
You really are. You cannot compare its performance against industry peers if its cost structure is artificially suppressed by a related party.
And if we connect this to the bigger picture, there are essentially two competing economic views on why related party transactions even exist in the first place.
Because if they're so risky, why do regulators allow them at all, right?
Exactly. The first view is the efficient transaction view. The perspective argues that dealing with related parties can actually reduce transaction costs significantly.
Okay, how so?
Well, it can secure fragile supply chains, it can enhance the enforcement of property rights and contracts within a complex corporate group. In this view, it's just good, efficient business.
Let me push back on that for a second, though.
Yeah.
If you have a giant corporate umbrella, say a massive tech conglomerate, and you force all the subsidiaries to deal with each other at arm's length, meaning they have to negotiate prices like strangers and squeeze every penny out of each other, doesn't that completely defeat the purpose of having a conglomerate?
That's a great point.
Doesn't that destroy economies of scale? Like, if I own both the battery manufacturer and the electric car company, I want them seamlessly integrated, not fighting over profit margins in the boardroom.
That is the exact tension at the heart of the efficient transaction view. And you're right, vertical integration is incredibly powerful. If you have a highly specialized proprietary component that you need manufactured, keeping that transaction within your corporate family protects your intellectual property much better than outsourcing it to a third party.
It keeps the secret sauce secret.
Exactly. It reduces search costs, negotiation costs, and the risk of a supplier holding you hostage. The law recognizes this efficiency. That is why they are legal.
But there's a catch.
Always a catch. The requirement to price them at arm's length for tax and reporting purposes is designed to ensure that the profits are recognized in the correct jurisdiction and that minority shareholders aren't being fleeced.
Which brings us to the other side of the coin, the dark side of RPTs.
Yes, the conflict of interest view.
Tell me about that.
This view posits that related party transactions are fundamentally mechanisms for value destruction. They are the tools by which controlling shareholders or entrenched executives extract wealth at the direct expense of minority shareholders.
Here's where it gets really interesting. When we look at that conflict of interest view, there is a specific theoretical framework used by economists to understand exactly how this wealth transfer happens.
Right, the Friedman model.
Yes, often referred to as the Friedman model. And it focuses on two distinct opposing behaviors, tunneling and propping. Let's break those down, starting with tunneling. How exactly does one tunnel wealth out of a company?
Tunneling is the process where controlling shareholders expropriate a listed firm's assets. And this usually happens when the firm is in very sound financial condition.
So when the company is flush with cash.
Exactly. Imagine a publicly traded company that is highly profitable, generating massive cash flows. The controlling shareholder, who maybe owns, let's say, 40% of the public stock, also owns a private holding company outright.
So 100% ownership of the private one.
Yes, 100%. Through tunneling, they might force the public company to sell its most valuable assets, say prime real estate or key patents, to the private holding company at significantly below market prices.
Basically stealing the assets.
Essentially, yes. Or, conversely, they might have the public company overpay for consulting services provided by the private entity.
It's like being a co-owner of a highly profitable, packed restaurant where you own 40% and outside investors own 60%.
Okay, good analogy.
But you also secretly own the linen supply company down the street, 100%. You use your control of the restaurant to sign a contract with your linen company, charging the restaurant $100 per napkin.
That would definitely do it.
Right. Suddenly, the restaurant's profits completely vanish. The outside investors get absolutely nothing in dividends because the restaurant looks like it's barely breaking even. But you are getting incredibly rich through the back door.
You're capturing 100% of the inflated linen profits instead of splitting the restaurant profits with your co-investors.
Exactly.
That is a perfect illustration of the mechanics. In essence, they are siphoning cash and profits out of the public firm where they have to share the wealth with the minority shareholders and tunneling it directly into their own private pockets where they keep every single cent. It is pure extraction.
But then we have the exact reverse mechanism, which is called propping.
Right, the other side of the Friedman model.
This happens when a company faces a severe negative shock, or maybe the imminent risk of going bankrupt or being delisted from an exchange entirely.
Right.
In this scenario, the controlling shareholders actually inject their own private resources into the struggling public company to temporarily boost its performance and save its listing status.
Yes, so instead of taking value out, they pump value in. They might have the private holding company buy toxic, non-performing assets from the public company at massively inflated prices.
Wow.
Or they might provide zero-interest loans that they never actually expect to be repaid.
So my question here is really about the core motivation. Why would a controlling shareholder throw good money after bad?
It's a great question.
If the public company is failing, if the core business model is broken, why prop it up? Are they just protecting the prestige of being a public company CEO? Or is there a hard, measurable financial incentive to do this? Because it seems totally irrational to subsidize a failing business out of your own pocket.
It seems that way, but it is entirely about the financial incentive. And it's highly rational from their perspective.
Oh, so?
Because losing access to capital markets or losing the rights to issue new equity completely destroys the controlling shareholders' long-term private benefits.
Okay.
If the firm is delisted, it loses its ability to raise public funds in the future. The controlling shareholder is essentially bailing out the sinking ship today so that they can continue to sail it and potentially tunnel from it again tomorrow.
That makes perfect sense. It's an investment in future extraction.
Exactly.
You keep the host alive so the parasite can keep feeding later.
That is a very grim but very accurate way to put it. They are protecting their access to the public markets, which is the ultimate source of their wealth extraction.
Wow. So as an analyst or an auditor trying to figure out if a transaction is a legitimate, efficient deal or a tunneling operation, how do we test it? You mentioned the arm's length principle earlier, that we have to ask if strangers would do the deal.
Right.
But how do tax authorities and sophisticated analysts actually evaluate that in practice? There'll just be a gut feeling like this looks weird.
Oh no, it's not a gut feeling at all. There is a rigorous theoretical framework based on 5 comparability factors.
5 factors, okay.
If a company wants to prove to a tax authority or an auditor that a transaction is truly arm's length, they have to run it through this specific gauntlet. And as an analyst, you need to understand these factors so you can spot when management's logic is fundamentally flawed.
Let's walk through them in detail, because this is where the theoretical rubber meets the practical road for a DCF model.
Absolutely.
Factor number 1. Contractual terms.
Right. So this factor examines both the written agreements and the actual day-to-day conduct of the parties.
So it's not just what's on paper.
Exactly. Do the contracts reflect how the parties actually behave in reality? Let's say a parent company lends a subsidiary $10 million. The written contract says it's a standard 5-year loan with a 7% interest rate, and interest payments are due quarterly.
That sounds normal.
On paper, that looks perfectly arm's length.
But wait, what if we look at the cash flow statements for the last 3 years and the subsidiary hasn't made a single interest payment?
Exactly. If the related party hasn't paid in 3 years and the parent company hasn't made any collection efforts, no penalty fees, no threats of default, no restructuring, then the actual conduct overrides the written contract.
Because no real bank would do that.
No independent stranger bank would tolerate a 3-year unpaid commercial loan without taking aggressive legal action or forcing bankruptcy.
So from an analyst perspective, if you see that, you realize this isn't actually debt. It's an equity injection disguised as debt. And that fundamentally changes how you calculate the company's weighted average cost of capital, of their WACC, because their true capital structure is entirely different from what's being reported.
Yes, it completely changes the math. Factor 2 is the functions performed. This requires a deep functional analysis of the transaction. Who actually does what to generate the value?
So if I'm looking at functions performed, let's say a US-based software company sells its enterprise software to a wholly owned subsidiary in Ireland, and then the Irish subsidiary sells it to the rest of Europe.
A very common structure.
Right. If I'm trying to figure out what profit margin the Irish subsidiary should legally get to keep, I have to figure out what they actually do, right?
That's right. You have to look at their physical operations. Do they have a massive office in Dublin? Do they have 100 salespeople, localization engineers, marketing teams, and customer support staff?
Right, real infrastructure.
Exactly. Or is the subsidiary literally just a brass plaque on a door, a mailbox, and a single lawyer processing paperwork, while all the actual sales and coding happen back in Silicon Valley?
Because if they perform significant complex functions, like managing the entire European sales pipeline, they should earn a substantial profit margin, consistent with independent distributors performing those same complex functions.
Naturally, yes.
But if they are just a mailbox, they're only entitled to a tiny nominal fee for administrative processing. The rest of the profit belongs to the U.S. parent.
Exactly, which ties directly into factor 3. Assets used. What tangible and intangible assets are employed in the transaction, and who legally and economically owns them?
Intangibles are the really tricky part here, aren't they? Patents, trademarks, algorithms.
They are the absolute hardest part of transfer pricing. If a U.S. tech company develops a revolutionary, globally recognized search algorithm, and they license the rights to use that algorithm to a subsidiary in Bermuda,
which happens a lot,
the royalty rate the subsidiary pays back to the U.S. must reflect the immense value of that intangible asset. If an independent tech company would happily pay a 20% royalty on gross revenues to license a comparable algorithm, then 20% is likely the arm's length rate.
And if the U.S. parent is only charging the Bermuda subsidiary a 1% royalty, they are tunneling profits out of the high-tax U.S. jurisdiction and parking them in the zero-tax Bermuda jurisdiction.
Because the asset value doesn't match the pricing.
Exactly. All right, factor 4 is risks assumed. This one seems absolutely crucial for modeling and forecasting cash flows.
It is the bedrock of corporate finance. Risk and reward must be correlated. Who bears the commercial and financial risks in the transaction?
What kind of risks are we talking about?
We are talking about inventory obsolescence, currency fluctuations, credit risk, market demand risk. In a truly independent relationship, if you take on more risk, you demand a higher potential return.
Let me make sure I'm getting this. Say a manufacturing parent company forces a retail subsidiary to buy massive amounts of inventory, but the parent signs an agreement guaranteeing that the subsidiary will always make a guaranteed 5% operating margin.
Okay.
And that's regardless of how much inventory actually sells to the public. If the inventory goes obsolete, The parent absorbs the loss to keep the sub at a 5% margin.
In that scenario, the subsidiary isn't bearing any market risk whatsoever. They are essentially insulated from the free market entirely.
So it's basically a risk-free return for them.
Therefore, the pricing of their transactions must reflect that incredibly low risk profile. They shouldn't be earning the high returns of an independent retailer who risks bankruptcy if a product flops. They should be earning a return closer to a risk-free government bond.
Risk allocation must mathematically match actual control over those risks.
Perfectly stated. And finally, factor 5, economic circumstances.
What does that entail?
This looks at the broader macroeconomic conditions and the specific regulatory environment of the markets involved. Are the markets genuinely comparable?
Give me an example.
Well, you cannot compare the profit margins of an independent distributor operating in a highly regulated, mature, low-growth market like Germany with a related party distributor operating in a booming, deregulated, hyper-growth emerging market.
Even if they're selling the exact same widget.
Even if they sell the exact same physical product, the economic circumstances dictate that independent parties would demand entirely different terms and margins.
So if a transaction fails this 5-factor test, if the price is wildly off market rates, if the risk allocation makes zero commercial sense, if there's no real business purpose other than shuffling tax liabilities, then the reported financials are officially distorted.
Exactly. And the consequences of failing this test are severe. Tax authorities around the globe have immense power. They can step in and recharacterize the transaction or completely disregard it as lacking commercial substance.
Okay, let's move from the economic theory into the dark arts here.
Let's do.
Let's look at the actual mechanics of how this manipulation happens in practice. Because as an analyst, you aren't just looking for tax violations. Your primary concern is earnings manipulation.
Right. You want to know if the EPS is real.
Exactly.
Right.
You're trying to figure out if the earnings per share is real. Let's start with a scenario where management wants to artificially increase net income.
This is a classic pervasive setup. Imagine it's December 15th. Management is reviewing the year-end preliminary numbers.
Sweating a little bit.
Oh, definitely. The CEO and the CFO have a lucrative compensation structure where they receive massive, multi-million-dollar stock options and cash bonuses if and only if the company hits a $10 million net profit target for the fiscal year.
A hard target.
Very hard. But looking at the current projections, the core business is slowing down. They are going to fall just short. They are projecting a net income of $9.7 million.
So they are staring at a $300,000 shortfall.
Yep.
That tiny gap is standing between them and a life-changing payday. What is the play? How do they close that gap with 2 weeks left in the year?
Well, they can't just invent fake external customers because the auditors will catch that. Auditors send out confirmation letters to independent third-party customers to verify accounts receivable.
Right.
If you make up a fake customer, the confirmation letter bounces and the fraud is exposed immediately. So the play is a related party transaction.
Okay, how does that work?
They develop a scenario where a commonly owned shell company, a separate legal entity that they also control the bank accounts and accounting for, pays their primary public business $350,000.
Just to clear the hurdle.
Exactly.
They execute this bogus transaction on December 27th, right under the wire. And they probably write a vague journal entry describing it as a payment for, I don't know, prior consulting services or management fee allocations.
Strategic synergies, whatever sounds good. The accounting mechanics are simple but devastating. They debit accounts receivable for $350,000 and they credit revenue for $350,000.
What are the auditors?
Because they control both sides, if the auditor sends a confirmation letter to the shell company asking, "Do you really owe this money?" the CEO simply signs the letter on behalf of the shell company and sends it back to the auditor. Yes, we owe it.
Wow. They just magically created revenue and circumvented the primary audit control.
Oh, and the result. The net income target is officially hit. The board approves the financials. The massive bonuses are triggered.
The CEO buys a new Tesla. The CFO takes a luxury trip to Europe.
And it was all done with a few keystrokes between two entities they effectively control. It is a transaction entirely outside the normal course of business with zero standalone commercial rationale.
That is the tunneling aspect, pulling value or manipulating the numbers to extract a bonus. But strangely, and this is something that often confuses junior analysts, Sometimes companies actually want to artificially deflate their earnings.
Yeah, the cookie jar approach.
Right. Why on earth would a company decrease its net income? Why hide success?
It's all about managing expectations. It usually happens during an unusually, perhaps unsustainably good year. Let's say a commodity company has a blowout year because of a temporary spike in prices.
Like lumber prices shooting through the roof.
Exactly. They know next year will likely revert to the mean. Management wants to defer some of that massive net income to future periods to smooth their earnings. Wall Street analysts absolutely love predictable, smooth, quarter-over-quarter earnings growth.
It commands a higher price to earnings multiple.
It really does.
Right. If you show a massive 50% spike one year, the market builds that into their baseline. The expectations for the next year become mathematically impossible to meet, and when you inevitably miss them, the stock tanks.
Exactly. So to prevent that impossible baseline, the company creates what we call cookie jar reserves using related parties.
How do they do that?
They make related party payments, perhaps prepaying for years of future licensing fees or consulting services, to a subsidiary, effectively shifting massive expenses into the current year. This severely deflates the current year's peak earnings.
So they're hiding the cash in the cookie jar for later.
Right. Then, in a future, less profitable period, the related entity might send that value back, perhaps by canceling the contract and refunding the money, recognizing it as revenue right when the public company desperately needs a boost to meet analyst estimates.
Smooth earnings, completely artificial.
Yeah.
So if you are the analyst reading the 10K, what does this all mean for your workflow?
You have to be incredibly vigilant.
You are looking for those round dollar amounts in the footnotes, like the exact $350,000 example. Real business transactions with independent parties are rarely perfectly round numbers.
Yeah, they have odd dollars and cents based on actual hourly rates or unit pricing.
Exactly. You are looking for vague journal entries like for prior services or strategic allocation. If you see a transaction that lacks a clear standalone commercial rationale, red flags should be going up everywhere.
Another massive glaring red flag to look out for in the wild is consistent systemic losses in one jurisdiction while affiliates remain highly profitable.
Ooh, that's a big one.
It is. If a company's manufacturing arm in Mexico is losing money every single year for a decade, but the intellectual property holding company in the Cayman Islands is posting 90% profit margins, that defies economic logic.
Because a truly independent manufacturer would just go bankrupt or shut down after a decade of losses.
Right. This almost always signals that the company's using non-arm's length transfer pricing to artificially shift profits out of the high-tax manufacturing jurisdiction and into the zero-tax haven.
And tax authorities do not take kindly to being treated like a piggy bank, which brings up transfer pricing adjustments.
They will come after you.
If you are modeling a multinational company and you realize their related party transactions clearly aren't arm's length, you can't just build your DCF on their reported tax rate. You have to account for the very real impending risk of tax penalties.
And those penalties can be absolutely devastating to a firm's cash flow. If a tax authority like the IRS in the US or HMRC in the UK audits the firm and determines a transaction wasn't arm's length, they won't just ask nicely for the difference.
No, they play hardball.
Very hard. They will unilaterally adjust the taxable income upward. This frequently leads to double taxation, where the exact same income is taxed in two different countries because the counterparty's jurisdiction might refuse to offer corresponding relief.
They might say, hey, we already taxed that profit. We aren't giving it back just because the IRS wants it.
Exactly.
So you are paying taxes twice on the exact same dollar of profit.
And
then come the penalties.
Oh, the penalties on top of the adjusted tax bill are extraordinarily steep. In the U.S., under Section 6662, you are looking at 20 to 40% penalties on the underpayments attributable to transfer pricing misstatements.
Ouch.
In the UK, they have aggressive tax-geared penalties for careless or deliberate errors that can completely wipe out margins. And in India, the penalty on transfer pricing adjustments can be anywhere from 100 to 300% of the tax sought to be evaded.
Wow. A 300% penalty will absolutely detonate a valuation model.
It's a nuke.
If you modeled a 10% cost of capital in steady cash flows, and suddenly a $50 million cash penalty hits the balance sheet, your price target for that stock is completely wiped out.
It is. And beyond the immediate cash hit, The reputational risk of a high-profile public transfer pricing dispute can severely damage stakeholder relationships, trigger debt covenants, and destroy long-term firm value.
Okay, we cannot talk about the mechanics of earnings manipulation, special purpose entities, and catastrophic governance failures without talking about the defining case study of modern financial history.
Here we go.
The blueprint for how related party transactions can destroy billions of dollars in wealth. Let's talk about Enron.
Enron. It is the ultimate terrifying cautionary tale of what happens when related party transactions, combined with incredibly complex corporate structures, are intentionally and systematically used to deceive the public markets.
Let's set the stage for anyone who might only know the name. Enron originally made its money as a relatively boring traditional energy company.
Very traditional.
They built and maintained physical power plants, natural gas pipelines, and processing facilities. Real tangible assets. But under the guidance of Jeffrey Skilling, their visionary but deeply flawed executive, they shifted massively away from physical assets and into wholesale trading and financial risk management.
They wanted to be the Goldman Sachs of energy.
Yes, exactly. And a key part of the illusion they built relied heavily on how they recognized revenue from those trades.
This is a critical accounting distinction that analysts must understand. We have to contrast the agent model with the merchant model.
Break that down for us.
Traditionally, trading companies or brokerage houses like Goldman Sachs or Merrill Lynch operated strictly under an agent model for their facilitation services. When they facilitated a massive trade between a buyer and a seller, they only reported their specific trading or brokerage fee as top-line revenue.
So they were providing a matchmaking service. They were not taking on the primary credit risk or inventory risk of the underlying assets.
Right.
So if Merrill Lynch facilitates a $100 million stock trade and they charge a 0.1% fee, they book $100,000 in revenue.
Exactly. Very straightforward. But Enron elected very deliberately to use the merchant model for their energy trading.
Explain how that distorts the scale of the company.
Well, under the merchant model, Enron claimed they were acting as a principal, not just an agent. Therefore, they reported the entire gross notional value of every single trade as top-line revenue.
So wait, if Enron facilitated a massive multi-year natural gas contract with a total notional value of $50 million.
They booked the entire $50 million as top-line revenue immediately, even if their actual operating profit on that spread was only $50,000.
That is an incredibly aggressive accounting interpretation.
It's insane.
It artificially inflated their revenue to astronomical levels. It didn't necessarily change their net income, but it made their top-line revenue look like they were dominating the global economy, pushing them instantly into the top tier of the Fortune 500. They looked like an unstoppable juggernaut.
And the competitive pressure this created was immense. To keep up with that grand illusion, other legitimate energy companies like Duke Energy and Dinergy felt forced to start adopting the exact same aggressive merchant model accounting just to stay competitive in the market rankings and keep their stock multiples high.
It corrupted the entire sector's reporting.
It did. But the revenue recognition was only part of the puzzle. The real weapon of mass destruction in Enron's accounting arsenal, the thing that ultimately doomed them, was mark-to-market accounting.
Yes, mark-to-market. Prior to Skilling taking over the trading desk, Enron's natural gas business accounting was straightforward and conservative. They recorded the actual costs of supplying gas when they bought it and the actual revenues when they physically delivered and sold it. Historical cost matching.
Very traditional.
But Skilling vehemently demanded that the trading business adopt mark-to-market accounting, claiming it was the only way to represent true economic value to investors.
And Enron actually lobbied for and became the first non-financial company to use this specific method for complex long-term physical contracts. Wow. The SEC actually approved this for them in 1992 for their natural gas futures business. But how exactly does it work mathematically, and how did they abuse it so spectacularly?
Hold on, let me make sure I'm getting the premise of this before we get into the abuse. Are you saying that under mark-to-market, they booked 20 years of hypothetical cash flows on day one?
Yes.
How is that even legal under GAAP? Doesn't accounting require revenue to be actually realized, or at least realizable, before you can claim it as income?
In traditional manufacturing or retail, yes. But in financial trading, mark-to-market requires that the moment a long-term contract or derivative is signed, the company must estimate the present value of all net future cash flows expected from that contract over its entire life.
Oh, man.
They discount those future estimates back to today, and they record that entire estimated net present value as current income on the income statement immediately, day one.
So if I sign a 20-year contract today to supply electricity to a city, I get to build a model guessing what the price of electricity will be in the year 2015, guessing my future costs, discounting it back, and I put that entire 2 decades of estimated profit on today's income statement to hit my quarterly bonus target.
Precisely. You can see the immediate danger.
It's all just a guess.
Right. The problem is that the long-term viability of these bespoke energy contracts, the counterparty credit risk over 20 years, and the future forward curve prices associated with them were incredibly difficult, if not impossible, to estimate accurately.
You were just making it up.
Basically. Investors were given completely false reports because there were massive, glaring discrepancies between the astronomical reported profits on the income statement and the actual cash coming in the door on the cash flow statement. They were recording hundreds of millions in net income that they might never actually receive in physical cash.
This is a classic CFA lesson. When net income is soaring, but cash flow from operations is stagnant or negative, earnings quality is terrible. Red flags should be waving furiously.
Definitely.
And the fatal flaw of this mark-to-market system is that it creates an absolute treadmill that management can never, ever get off. Because you pulled 20 years of future profit into year 1, year 2 has absolutely zero profit left from that specific contract.
Exactly. To show Wall Street the continuous earnings growth they demand the next year, you have to sign even more, increasingly larger, increasingly desperate deals just to front-load more imaginary profit to beat last year's inflated numbers.
It's a Ponzi scheme of accounting.
As one competitor aptly put it, if you accelerate your income like a drug, you have to keep doing more and more deals just to show the same rising income. The fundamental economics of the deals begin to matter less than the day one accounting treatment.
A perfect, almost comical example of how absurd this estimation process became was the Blockbuster video deal.
Oh, the Blockbuster deal.
In July of the year 2000, Enron and Blockbuster signed a highly publicized 20-year agreement to introduce on-demand entertainment streaming video to various U.S. cities over Enron's broadband network.
Right.
Based on a few tiny, unproven pilot projects, Enron's internal models immediately claimed estimated future profits of more than $110 million from the deal. They booked that entire $110 million immediately as profit that quarter.
And analysts at the time were highly skeptical. Remember, this is the year 2000.
The dial-up era.
Exactly. The technical viability of streaming high-definition video over dial-up or early DSL and the actual consumer market demand for broadband video on demand were completely unproven.
Their skepticism was entirely warranted. The technological hurdles were massive, the content licensing fell apart, and both parties completely withdrew from the contract by March 2001, less than a year later. The venture was an utter failure. No cash was generated. Yet, Enron continued to claim those future profits on their books. They didn't reverse the $110 million. They left the imaginary profit sitting there, even though the underlying deal resulted in a total loss.
That is staggering hubris. But even with incredibly aggressive revenue recognition and fantasy mark-to-market accounting masking their poor operating performance, Enron was still racking up massive real-world debts from these failed broadband and power plant deals.
The cash was bleeding out.
Yes. And this is where the special purpose entities, or SPEs, come in. This is where we see the ultimate toxic, weaponized form of related party transactions.
Explain what an SPE actually is, legally speaking.
Enron utilized hundreds of special purpose entities. Legally, these are limited partnerships, trusts, or shell companies created for a temporary, highly specific purpose. Usually in legitimate finance, they are used to fund a specific project or manage risks associated with isolated assets like securitizing a pool of mortgages. But Enron used them for a single deceptive purpose: to completely hide its mountain of debt from the rating agencies and the public.
Right. They created these bizarrely named entities like Chuco, GDI, and White Wing.
Let's look closely at the mechanics of White Wing, because this shows exactly how you engineer a balance sheet.
Okay, let's get into it.
White Wing was formed in 1997 with $579 million from Enron and $500 million from an outside investor. Because an outside investor had a substantial stake, and because of how the control rules were written at the time, Enron argued they didn't have to consolidate White Wing's financials into Enron's main public reports.
And this deconsolidation is the critical foundational mechanism of the fraud.
Exactly. By keeping the entity off balance sheet, White Wing's massive growing debts no longer appeared on Enron's public financial statements. Enron's debt-to-equity ratio looked incredibly healthy to the rating agencies.
But where is the debt going?
White Wing, armed with billions in borrowed cash, was then used as a dumping ground. It purchased toxic, non-performing, heavily overvalued assets directly from Enron failing power plants, busted pipelines, plunging tech stocks.
Wow.
Between 1999 and 2001 alone, White Wing bought over $2 billion worth of terrible assets from Enron.
So let me get this straight. Enron sells a bad asset to White Wing. Enron books cash coming in and books a profit on the sale. The debt used to buy that asset sits hidden inside White Wing.
Yep.
It looks like a masterstroke of corporate restructuring. But here's the catch, the fatal flaw in the architecture, and this is where the related party deception peaks. Where did White Wing get the collateral to borrow that $2 billion from the banks?
They bought those assets using Enron's own stock as collateral.
Using their own stock. This is the definition of a house of cards.
It is. Enron disclosed in vague footnotes to shareholders that it had hedged its downside risk in illiquid investments using these special purpose entities. They made it sound like prudent risk management. But what they explicitly did not disclose was that these independent entities were using Enron's own stock and Enron's own corporate financial guarantees to finance the entire structure.
So let's walk through how that domino effect actually triggers. Enron capitalizes White Wing by giving it millions of shares of Enron stock. White Wing takes those shares to a bank and says, look, we have all this valuable Enron stock. Lend us $1 billion in cash.
And the bank does it.
The bank lends the cash. White Wing takes the cash and buys a failing water plant from Enron at a massive premium. Enron records the cash and the profit. Everything works perfectly, as long as Enron's stock price keeps going up. But what happens when the tech bubble bursts and Enron's stock price starts to fall?
The entire mechanism violently reverses.
How fast?
Very fast. If Enron's stock price falls, the value of the collateral sitting inside White Wing plummets. The banks that lent White Wing the money issue a margin call. They demand more collateral to secure the loans.
But White Wing has no cash.
Right. It spent it all buying Enron's junk assets. So Enron is contractually forced to issue millions of new, fresh shares of its own stock and pump them into White Wing to satisfy the banks.
But issuing millions of new shares massively dilutes the existing shareholder equity. When the market sees that dilution, the stock price drops even further.
Which triggers another, even larger margin call, which requires issuing even more shares. It is an unstoppable, mathematically guaranteed death spiral.
It's terrifying.
The asset transfers to White Wing weren't true arm's-length sales. They were essentially disguised, highly leveraged loans backed by the company's own share price, but they were booked as revenue to make Enron look financially healthy while hiding billions in toxic liabilities.
And this raises the most important question for anyone studying corporate governance. Where were the gatekeepers?
That's the billion-dollar question.
How did a scheme this massive, involving hundreds of shell entities, billions of dollars in fake revenue, and blatant manipulation of mark-to-market rules go unchecked for years? It represents a catastrophic, systemic failure of corporate governance at every conceivable level.
Let's start at the very top, with the board of directors. On paper, if you looked at their proxy statement, Enron had a model textbook board. They were predominantly esteemed outsiders, former regulators, and academics with significant ownership stakes. In the year 2000, Chief Executive Magazine actually named Enron among its 5 best boards in America.
Yet a subsequent Senate subcommittee investigation revealed that the board was intimately aware of the rationale for using these highly conflicted White Wing and Raptor SPE transactions.
They knew.
Management explicitly told them these entities were designed to manage earnings and hide debt, and the board formally approved them. Why? Because the board was heavily structurally incentivized by stock options.
It's always the incentives.
Management was constantly obsessively focused on the daily stock price. At internal budget meetings, Jeffrey Skilling would literally ask his executives, what earnings do you need to report to keep our stock price up? And they would just reverse engineer the accounting to hit that fabricated number, whether the actual business supported it or not.
And the board members were making absolute fortunes off this inflated stock. Using the peak January 2001 stock price, Chairman Kenneth Lay's personal stock ownership was valued at $659 million.
Wow.
And Skilling's at $174 million. They had every financial incentive in the world to keep the music playing, to ignore the complex accounting risks, and to let the SPEs continue functioning as a debt-hiding mechanism. But you have to ask, what about the audit committee of the board? Weren't they specifically tasked with preventing exactly this kind of financial engineering?
The audit committee was heavily criticized post-collapse for holding incredibly brief, superficial meetings that skimmed over massive amounts of highly complex technical material.
They just rubber stamped it.
They were presented with structured finance diagrams they clearly didn't comprehend. They simply did not have the technical accounting knowledge regarding synthetic derivatives, mark-to-market valuations, or the consolidation rules of special purpose entities to properly question management or challenge the outside auditors.
They were fundamentally unequipped to understand the economic substance of the very transactions they were approving.
Which brings us to the ultimate, most infamous gatekeeper failure of all. Arthur Andersen, Enron's external accounting firm.
Oh, Andersen.
Andersen was one of the esteemed Big Five accounting firms in the world, and they were the ones signing off on Enron's books, telling the public that these financial statements fairly represented reality. But there was a massive, systemic, unmanageable conflict of interest at the heart of their relationship.
Let's look at the numbers of that conflict, because they are staggering.
Walk us through them.
During the year 2000, Arthur Andersen earned $25 million in traditional statutory audit fees from Enron. But crucially, they also earned $27 million in non-audit consulting fees from Enron.
So they made more on consulting than auditing.
Yes. They were helping design the very internal IT and accounting systems they were later supposed to objectively audit. Enron was an absolute behemoth for Andersen. It accounted for roughly 27% of the total audit fees for Andersen's entire Houston office.
You simply cannot independently and objectively audit a client when your entire regional office is completely reliant on them for $52 million in annual revenue.
It's impossible.
More than half of which comes from consulting on the very aggressive, borderline illegal systems you were supposed to be stress testing. If you blow the whistle on the audit, you lose the $27 million consulting contract immediately.
The conflict was absolute and corrupting. Enron actively exploited this leverage. They hired numerous former CPAs and former Financial Accounting Standards Board accountants specifically to search the accounting literature for obscure loopholes.
They were hunting for them.
Yes. One Enron accountant literally stated in an interview, "We tried to aggressively use the literature to our advantage. We got to where we did because we exploited that weakness." And when Andersen's ground-level auditors occasionally hesitated or pushed back against a particularly egregious SPE structure, Enron management aggressively pressured and threatened them.
They pressured them to defer, recognizing massive impairment charges from the failing special purpose entities. Even though strict accounting guidelines required Enron to take a write-off because the entities were clearly underwater and would never return a profit, Enron bullied Andersen into ignoring the rules just to meet Wall Street's quarterly earnings expectations.
It's blatant intimidation.
Enron management would even ostentatiously bring in competing firms like Ernst & Young or PricewaterhouseCoopers to complete small, lucrative consulting tasks, just to create the explicit, looming threat that they might replace Andersen entirely if Andersen didn't play ball in the audit.
And the internal quality controls at Andersen completely and utterly failed. The Houston office, because of the massive prestige-generating fees they brought in, was granted unprecedented autonomy. They were routinely able to overrule critical conservative reviews of Enron's aggressive accounting decisions made by Andersen's Central Risk Management head office in Chicago.
The partners making the money were allowed to police themselves.
Exactly. And when the music finally stopped, when the stock price crashed, the margin calls hit the SPEs, and the SEC investigations became public knowledge, the cover-up began in earnest.
To shredding.
Arthur Andersen employees, panicking about liability, shredded several tons of relevant audit work papers and documents and permanently deleted nearly 30,000 emails and computer files related to the Enron engagement.
The fallout was biblical. It was the largest bankruptcy reorganization in U.S. history at the time, wiping out billions in shareholder value and employee pension funds overnight. It led directly to the criminal indictment and complete dissolution of Arthur Andersen as a global firm, reducing the Big Five to the Big Four.
A historic collapse.
It is universally cited as the biggest audit failure in modern history, and there were massive tragic human costs. Thousands of employees lost their life savings because their retirement accounts were locked into Enron stock.
And the executive fallout was severe, too.
The NatWest three British bankers who colluded with Enron CFO Andrew Fastow to personally enrich themselves via a special purpose entity were extradited and sentenced to federal prison for wire fraud. A potential witness in the banking investigations, Neil Kolbeck, was found dead in a London park in a ruled suicide. The regulatory and human fallout was global and catastrophic.
And it all stemmed from the intentional abuse of related party transactions, the weaponization of complex entity structures, and a complete breakdown of gatekeeper independence.
So let's step back from the spectacular fraud of Enron and look at how these dynamics, specifically the Friedman model of tunneling and propping, play out in other global markets. Because the motivations for RPTs change dynamically depending on the economic environment and the financial health of the firm. Let's look at the empirical evidence from China.
The Chinese stock market provides a truly fascinating real-time laboratory for observing tunneling and propping behavior. Because of the unique, highly structured regulatory environment governed by the China Securities Regulatory Commission, we can actually see quantitatively how the market reacts to related party transactions based entirely on the underlying financial health of the firm.
I want to understand the exact regulatory mechanics here. Explain the ST and PT designations in China, because they drive all the behavior we're going to talk about.
Right. So in the Chinese domestic exchanges, a listed firm is formally designated as a special treatment, or ST firm, if it reports a net loss for 2 consecutive fiscal years. It's a massive red flag painted on the stock.
Okay, 2 years of losses, your ST.
Yes. If it continues to struggle and suffers a net loss for 3 consecutive years, it is downgraded to a particular transfer, or PT firm, which entails severe restrictions, including the virtual suspension of daily trading.
That's a death sentence.
Pretty much. If a PT firm cannot engineer a return to profitability within 1 year, it is completely, permanently delisted from the exchange. Furthermore, to maintain the highly coveted right to issue new equity through a rights offering, firms have to historically maintain strict return on equity thresholds.
Like what?
For example, a mandate to maintain a minimum ROE of 6% for 3 consecutive years.
So losing that listing status or losing the right to tap the public equity markets is a massive existential blow to the controlling shareholders. The competition to even get an IPO quota in China is notoriously fierce. If a firm is delisted, the controlling shareholder loses immense, unrecoverable private benefits and prestige.
Exactly. They are highly motivated to defend that listing status at all costs. So when a firm receives an ST or PT designation, they are in deep systemic distress. They are facing the absolute cliff edge of delisting.
And this is where the market reactions become incredibly revealing. We would normally think that any company announcing a murky related party transaction would see its stock drop due to corporate governance fears.
Right, usually it's bad news.
But the data shows that when a Chinese firm is designated as ST or PT, meaning the market knows it's in desperate distress, and it suddenly announces a major related party transaction with its parent company, the stock market reaction is actually significantly positive. The stock price jumps.
What's fascinating here is why the reaction is positive. The institutional investors buying the stock aren't cheering for a genuinely great synergistic business deal. They are purely anticipating a bailout.
They know what's coming.
Yes. They know the controlling shareholder is absolutely terrified of the impending delisting, so they rationally assume the related party transaction is a massive propping maneuver.
Right. They expect the wealthy private parent company to swoop in and aggressively inject good cash-generating assets into the public shell, or buy the public shell's toxic bad assets at wildly inflated prices, or provide highly favorable zero-interest loans.
Anything to save it.
They know the parent company will do whatever it takes to artificially boost that ROE just over the 6% threshold to save the listing status. The positive market reaction is simply the market efficiently pricing in the controlling shareholders' desperation to prop the firm up with their own private wealth.
But if we flip the script and look at the other side of the Friedman model, what happens when a Chinese firm is in very sound financial health? It's highly profitable, it easily clears the ROE hurdles, there is zero risk of delisting, and it's generating great free cash flow.
When a healthy firm announces a related party transaction, the empirical data shows the market reaction is significantly negative. The stock gets punished.
Because the market instantly assumes tunneling.
Precisely. If the firm is doing incredibly well, there's absolutely no regulatory or financial need for a parent company bailout. Therefore, the market rationally assumes the controlling shareholder is using the transaction for the only other logical purpose, to siphon accumulated wealth out of the public company and into their private, 100% owned holdings.
Just sucking the cash out.
Yep. They assume the public company is selling assets too cheaply to the parent, or buying raw materials too expensively from the parent. The negative stock reaction is the market instantly pricing in the expected expropriation of minority shareholder wealth.
It is a perfect textbook illustration of the Friedman model operating in the wild. The exact same type of transaction is viewed as a lifeline when sick and a parasite when healthy. And we see very similar, deeply ingrained structural dynamics in Korea with the cables, the massive family-controlled business conglomerates like Samsung or Hyundai.
How does the tunneling mechanism typically work within the cable structure?
In Korea, there is a long documented history of chaebol founding families using unlisted, deeply private companies at the top of the pyramid structure to extract wealth from the publicly listed operating subsidiaries further down.
Because they control the boards.
Right, because they control the boards of the public companies, they might use related party transactions to force the public companies to funnel massive, hefty, above-market dividend payouts or exorbitant management fees up to the unlisted holding companies.
Which the public never sees.
Exactly. These unlisted companies serve as a completely opaque, illicit means to transfer wealth directly to the founding families at the direct expense of the retail and institutional public shareholders.
But the academic research on the Korean market also points directly to the solution. How do you empirically stop, or at least mitigate, this kind of systemic tunneling?
Governance. The data is clear. The presence of truly independent directors on the board, not just golfing buddies of the CEO, but independent voices, significantly curtails abuse.
That makes sense.
Furthermore, a high ratio of outside director attendance at board meetings, directors with actual verifiable financial and accounting expertise, and the employment of top-tier Big Four external auditors, these factors mathematically reduce the incidence of manipulative-related party transactions.
So strong oversight actually works.
It does. Robust structural corporate governance acts as a direct, measurable check on the controlling shareholders' ability to tunnel.
Okay, let's tie all of this extensive theory and history directly into the exam context and the cross-topic connections that a practitioner needs to master. If you are a CFA candidate sitting for an exam or a junior analyst building a live DCF model for a hedge fund, how does this actually hit your desk? What are the mechanical adjustments you have to make? Let's start with financial reporting and analysis, or FRA.
In FRA, your primary job is to aggressively identify off-balance sheet liabilities exactly like the hidden debt in Enron's special purpose entities, and to proactively adjust reported earnings for any non-arm's length transactions you find in the footnotes.
Right.
If you identify a supply contract between a parent and a subsidiary that clearly fails the five-factor arm's length test we discussed, you cannot just passively take the reported revenue or cost of goods sold at face value.
So if a subsidiary is buying raw steel from its parent company at 20% below the global spot market price, their reported gross margin is a complete fiction.
Exactly. You have to manually adjust the financials in your model. You must increase their cost of goods sold to reflect the true arm's length market price of steel, which will immediately crush their reported gross margin and lower their net income, reflecting the true economic substance of the standalone business.
Then there's the corporate governance dimension. Post-Enron, the regulatory landscape shifted massively to address these exact vulnerabilities.
It did. The Sarbanes-Oxley Act of 2002, or SOX, in the U.S. was a direct, forceful legislative response to the Enron disaster.
It changed everything.
It really did. It created the Public Company Accounting Oversight Board, the PCAOB, to strictly regulate the auditors who had previously regulated themselves. It explicitly restricted accounting firms from providing lucrative, non-audit consulting services to the specific clients they are auditing permanently, closing that $27 million conflict of interest loophole that Arthur Andersen so aggressively exploited.
No more double dipping.
Exactly. It required public companies to have a majority of independent directors on their boards. And crucially, addressing the failure of Enron's board, it mandated that audit committees be genuinely financially literate, requiring at least one member to be a financial expert with actual accounting or related financial management experience.
They finally made sure that the people approving the math actually understand how the math works.
Yes.
And finally, the ultimate goal of all this analysis, equity valuation. How do related party transactions impact a discounted cash flow model?
This is where the rubber meets the road for an analyst. If you are valuing a company and you realize their profit margins are currently artificially inflated because they are actively being propped by a parent company supplying cheap raw materials to avoid a delisting, you cannot irresponsibly project those inflated margins into perpetuity in your terminal value calculation.
Because the propping is temporary. The parent won't subsidize them forever.
Exactly. A prudent analyst or CFA candidate must normalize those operating margins downward to reflect true, independent market costs before projecting cash flows and applying a DCF model. If you project propped up, subsidized cash flows into the future, your calculated enterprise value will be dangerously, perhaps catastrophically, overstated.
A huge common pitfall for candidates and junior analysts is relying too heavily on management representation letters to dismiss these risks.
Absolutely. You will often see a note in the 10K where management asserts that an RPT was conducted at arm's length.
Just trust us.
Right. Having a client sign a representation letter stating that a related party transaction is legitimate does not absolve the auditor of their duty to investigate, and it certainly does not absolve the analyst building the model. A signed letter from a conflicted CEO is just a piece of paper. Either the payment terms are empirically, economically supportable by third-party market data, or they are not. You have to verify the underlying economic substance yourself.
Which brings us to the most critical part of this entire analysis.
Yeah.
The one question. When you are staring at a dense, jargon-filled footnote disclosing a complex related party transaction, what is the single, punchy question you must always ask to cut through the noise?
The defining question is this. Would two completely independent strangers acting entirely in their own ruthless self-interest ever voluntarily agree to the exact pricing, risk allocation, and penalty terms of this specific transaction?
And why does that specific framing matter so much for an analyst?
If the honest answer to that question is no, then the reported financial statements are distorted, period. And you must manually adjust the revenue, expenses, or liabilities to reflect stark economic reality before trusting a single output from your valuation model.
It cuts right through the legal jargon and gets straight to the underlying economics. Would strangers do this deal? If not, someone is being secretly subsidized or someone is being quietly robbed. So let's recap the critical actual takeaways from this deep dive.
First, related party transactions are a complex double-edged sword. On one side, they can signal highly efficient internal markets, reducing friction costs and protecting valuable intellectual property within a corporate group. On the other side, they can be instruments of massive systemic value extraction, facilitating tunneling when a firm is healthy and cash-rich, or temporary propping when a firm is distressed and facing delisting.
Second, the arm's length principle is your absolute baseline for evaluation. You must rigorously analyze the 5 factors: the actual contractual terms versus conduct, the specific functions performed, the tangible and intangible assets used, the financial and commercial risks assumed, and the broader economic circumstances to see if the transaction genuinely mimics independent market behavior.
And third, robust structural corporate governance is the primary indispensable defense against RPT manipulation. Truly independent boards, financially literate audit committees capable of understanding complex derivatives, and objective, strictly regulated top-tier auditors are essential to ensuring that related party dealings don't devolve into the kind of systematic, world-shaking fraud we saw with Enron's special purpose entities.
As always, we have to remind you that this discussion is for educational purposes only and should not be construed as specific investment advice.
We highly invite you to open up the annual reports of your own largest portfolio holdings this week. Go straight past the glossy CEO letter and dive into the footnotes. Look specifically for the related party disclosures. You might be incredibly surprised by how structurally interconnected the operations really are and who is actually sitting on the other side of the negotiating table for some of their largest, most critical contracts.
Thank you for tuning in to Talk Tickers. We want to leave you with this final, slightly provocative thought to mull over as you build your next model. We've talked extensively today about how corporate management can manipulate RPTs to deceive the public markets.
Yeah.
But consider the role of the massive institutional investors themselves. If a giant passive index fund owns significant 5% stakes in both sides of a tunneling transaction, they own the public subsidiary being robbed, and they own the public parent doing the robbing. Do they actually care that value is being extracted from one and given to the other?
That's a great question.
Or is that blatant tunneling just a meaningless rounding error in a perfectly hedged, passively managed portfolio? Think about who in the modern market is really financially incentivized to stop the music. Until next time.